welcome to the Loan Officer Daily Rates Live with the Mortgage Calculator. We'll wait just a couple of minutes here to get started. Let us go live on all the different platforms. I put the chat up on the screen, so feel free to drop a comment there in the chat as you tune in. We definitely appreciate it. We'll get started here in just a moment. Happy Friday to everyone. Hope everyone's looking forward to a great productive day and making calls over the weekend as well. See some comments coming in there. Appreciate it. We'll wait just a minute here to get started. All right. It looks like we're live on all the different platforms, so we can go ahead and get it going here. Keep dropping comments there in the chat. We appreciate it. You can drop any questions you have as we go through our deep dive topic later in the chat as well. All right. So welcome, everyone. My name is Kyle Hershey. I am the COO of the Mortgage Calculator, joined here by our sales manager, Jose Gonzalez. We are a correspondent lender that specializes in non-QM loans. And what we do every morning on this show at 11 a.m. Eastern is go through some live rates. And then we do a deep dive into a different topic. Today's topic is going to be 1099 loans. So at the Mortgage Calculator, we specialize in non-QM and self-employed borrowers, and 1099 is a very popular loan for that. So Jose, our sales manager with 28 years of experience, is going to do a deep dive into 1099 loans here shortly. But first, he's going to pull up the pricing so we can see what the pricing is looking like today. So I will go ahead. Let me change the screen here and pull your screen up, Jose. And let's see here. All right. Sorry, let me go ahead and.
All right. Good morning, everybody. How are you? Thank you for joining us this morning for Daily Rates Live with the Mortgage Calculator. Great to be with you this morning from sunny and warm South Florida. So let's go over the action today. Yesterday was a little bit of mixed news in the pricing. So let's see where we stand today. Let's go over our conforming primary homes today. So we have it set at 80% loan to value, 760 FICO score, with the borrower paying one discount point to buy down the rate, right? So today's rate, let's see where we are. All right. So we are looking at best case option here. Looks like depends where the customer wants to be, 6.625 with one discount point for our conventional loan. So let's go now to our FHA. And again, these are primary owner occupied. So let's go with our FHA rate for today. Same parameters. Wow, look at that. 6% with 1 point, 6.125 with 3/4 of a point. So for our FHA loans today, we do see some positive action there. So VA loans and USDA loans, we do not price those live. VA loans are for our active military and veterans, and USDA loans are for our rural area properties. Great solution for those, 100% LTV. So please get with one of our team members to price out your USDA and VA loans. So let's get into our investment properties at the Mortgage Calculator. We love our investors. So let's go first with our conforming option. Again, purchase loan, same parameters, 80% LTV, 1 point buy down. And let's actually put the LTV to 80. System defaults to 60. Now, remember on these investment loans, 80% is the maximum LTV. That's one of the things that we love about our DSCR. So we're looking at 3 point. Here you go. I mean, again, this is going to depend on your compliance test, right? If you get bona fide discount points, because 3.125 may be a little bit on the high side, may not be compliant, but 2.125 at 7.625 should be a compliant rate. So that's where we're looking at, around 7.625 with 2.125 discount points for a conventional 80% purchase investment property. Right now, let's see how we stand with our expanded guidelines non-QM, right? I'm going to run the same scenario full doc, expanded guidelines, and let me put this to 80%, and then we'll go with our bank statement option and our DSCR option. So again, 80% LTV, 1 point loan discount, 760 credit, and let's see where that puts us on our. Wow. Now, look at the difference there, right? Look what we did. We basically went Fannie Mae or agency loan full doc, and it was 7.625 paying 2.125. We switched the same scenario to non-QM at an 80%, and now all of a sudden we're at 7.375 paying 0.875. So right there, you see the difference, the benefits with non-QM for investors, right? We have a one, like a what is that? 1.25 points cheaper at a quarter point lower interest rate going non-QM full doc, right? So now let's go and okay, and that was no prepayment penalty on top of that. So now let me add a 3-year prepayment penalty. So basically, apples to apples, there the full doc deal blew it away. So now the full doc non-QM deal. So now let's go with 12 months business bank statements. And actually, let me do the same scenario full doc with the 3-year prepay that I didn't have there. Let's see what type of difference we get there, because then I'm going to do banks. Oh my God, look at that. 6.99% at 3/4 of a point. Actually, no, hold on a second, my LTV switched back to 60. Let's put it at 80. And I got to reset the prepayment penalty on that too. So let's set it to 80. And the prepayment penalty to 3 years. Investment property, we're all set there again, and let's run it properly. So yeah, we get our 7.375. All right, so let's go back now and let's do our bank statement. Bank statement option, we're going to use 12 months, and bank statements are the most popular option here for non-QM, not just at the mortgage calculator, but in the industry. So we're going to go now. We have everything set. Okay, let's set it back to self-employed. Yes. Boom. 3-year prepay. 80% LTV. And business bank statements. And now we're good to go. Okay, 7.625. So like I always love to mention, not much of a difference in non-QM world between traditional full doc with tax returns for our self-employed borrowers and bank statements. You see the difference basically is 0.25% in the rate, 7.625 with 0.875 of a point. And now we are going to go with our flagship program, right? The DSCR. Now, 1099, that's what we're going to do today. Other options we could have would be P&L. But let's go direct to our all right, DSCR. Let's set our LTV to 80%. And we have a 3-year prepay, and let's set the DSCR to 1.25. Everything's set, and let's see where we are today in our DSCR rates. So, wow, now this is remarkable. 7.625 costing zero point 0.9 and 7.75 costing a half a point. Now, this is remarkable because if you recall, the agency rates that we obtained cost more, right? It was a much higher cost than this. So it really looks like DSCR is beating agency today in the investment properties. We've been seeing a lot of this lately. So again, when you are pricing out your investment deals for your self-employed borrowers, you yet haven't reviewed all of their info. It's always good to send them, if you know they're self-employed, send them the three option types. Full doc, you're going to send them bank statement, and then obviously the DSCR, which has nothing to do with their income type. So now today's deep dive is on 1099 loans. So, what exactly is a 1099, right? A 1099 is a document that the borrower will receive from the company that contracts them to do work. They are an independent contractor, so they are self employed, right? Now, so a lot of times there's confusion because the 1099 borrower a lot of times considers themselves an employee of the company because typically in many 1099 cases that is the only company that they contract to work for, right? Now that's not always the case, but usually the case. Now, one of the most popular 1099 borrowers that we're going to have are going to be real estate agents, right? That's a good example. Real estate agent has their license. They are self-employed, but their license is placed with one company, and that one company gives them a 1099 at the end of the year. Now, that doesn't mean that they may not get 1099s from other companies for doing other type of work, right? Because that's usually what companies do. Um, they contract you for a job of some type. You're not an employee of theirs. At the end of the year, they send you a 1099 for the amount of money that they paid you. But so 1099 is one of the main benefits. Now, again, self-employed borrowers only, but this is a great option to use other than bank statements. The reason being is that the expense ratio defaults to 10%, meaning that by default, unless there's something odd about their business per se, their self-employment, like that they actually may have employees, overhead, stuff like that. Unless you have some extenuating circumstance like that, the profit then is 90%, meaning that you can use 90% of the amount of the 1099 to qualify the borrower, versus what is usually the default on bank statement loans of 50%. Now, that's not always the default because we have options that default to 80% profit margin, 20% expense factor on self-employed bank statement loans if it's somebody in a service-related business that doesn't have any employees, right? That's why the business narrative is always so important on these self-employed borrower loans when they're 1099 and bank statements. So again, keep an eye out for self-employed borrowers. If they receive a 1099, do your analysis to see if 1099 may be a better option for that borrower rather than the bank statement loans. However, I will state though, the bank statement loans, due to the nature of how they review the monthly cash flow, the bank statement loans do have slightly better rates and LTVs than the 1099 loans. They're more because they're more popular. Remember that, right? I mean, bank statement loans right now, a lot of money in secondary, a lot of options are all competing for our business. Hence, there's going to be better rates. So let me go ahead and share with you the options that we have. I have four options for you today. I have primary purchase and investment purchase. So in this scenario, again, we have a 3-year prepay, 760 credit, and 80% LTV. Actually, no, 90% in this case. Maximum LTV for the primary purchase is 90%, and maximum LTV on any non-QM loan of any type is 90%. Obviously, you're only going to get 90% on the primary, not on the investment. So in this case here, at a 90% LTV, you're looking at 9.875 as your lowest cost option, and you can buy that down to 9%. Keep in mind, this is the maximum LTV. So as you lower the LTV, like if we were to go to 80% LTV, we would have a much lower rate. Now, this is our primary cash out option. Again, maximum LTV on our primary cash out option is 85%, right? And we have 9.625 as our lowest cost option, and we have 8.875 as our lowest rate option. And let me give you a couple of investment options here now for our investors out there. Maximum LTV is 85%. Now that's pretty amazing because, agency is 80%. So here we are at 85. We also have a DSCR option at 85. And we also have a bank statement option at 85. All of them higher LTVs than agency loans. Mortgage insurance, never applicable. So in this case, our lowest cost option is 9.375, and we can buy that down all the way to 7.75%. Not too shabby. And then our last option is our investment cash out for 1099. Again, maximum LTV is 80%. This also blows the doors off of agency. You cannot go 80% cash out investment on an agency loan, but you can do it all day long on non-QM. So here, 10.125 is our lowest cost option. And you can buy that down all the way to 7.999. And like I always state, don't forget that last 9. So good options here. I showed maximum LTV options because most of our investors, when they are doing their cash outs, if they're already spending money on the transaction, they want to max out the cash that they're going to get, because the expenses are pretty much going to be the same, just a little bit of a difference on loan amount due to title insurance and any transfer taxes that may be applicable. But other than that, everything else is going to be the same. So let's see what questions we have today. All right, I see a very good question here. I'll wait for Kyle to put that up so everyone can check it out. All right. So now this is one that is many times misunderstood, right? Does a self-employed borrower need to be vested in a business name? Well, the answer is no. Self-employed borrowers do not have to be vested in a business name. Now, remember, let's break this down into a couple of things here. Self-employed borrowers could be buying a primary residence. Self-employed borrowers could be buying an investment property. On a primary residence, you will never be vested in a business name. Primary residence will always be vested in a personal name. Now, does a self-employed borrower need to be vested in a business name if it's an investment property? Well, that depends how they want to structure their investment, right? Vesting in a business name gives you liability protection, but also vesting in a business name, like in an entity, LLC, corporation, or limited partnership, would be a requirement for the loan to be considered a business purpose loan, right? And only and business purpose loans are the only ones that, in certain scenarios, will not report on the borrower's personal credit, right? So, in some instances, we have some DSCR products when the borrower is closing in an entity that will not report to the borrower's personal credit, right? Because that loan is not using the borrower's personal income and they're closing in an entity. So depending on the option selected, because it's not every DSCR option will be considered, will be that type that won't report to their personal credit. So just be aware that it's not every DSCR closing in an entity that doesn't report, only some. So that would have to really be researched into the guidelines so that you can properly answer your borrower's request.
All right. That's the only one I see. So I think we'll go ahead and wrap it up. Remember, 11 a.m. Eastern every weekday we do this. Hold on. Let's see the other question coming in here. I guess part 2 of the question.
Oh yes.
Although it's not reported to the personal credit, is it still guaranteed by personal recourse?
All right, Daisy. Thank you for asking part 2 of your question. Yes. Right now, reporting on the borrower's personal credit is one thing, and the only reason the borrowers like that is because they want to free up their DTI for other purchases that may be on their primary, or maybe they're going to buy a car. Who knows what it is, right? But that does not mean that it is not personally guaranteed. That falls into what we're talking about: recourse and non-recourse. A loan with full recourse means that the borrower personally guarantees that loan, even if they're vesting in an entity. If it's a non-recourse loan, that means that they do not personally guarantee it. And the only loans you're going to see out there that are non-recourse are going to be large commercial loans, large true commercial loans, as in very large true commercial loans. So always verify with the conduit if it is truly a non-recourse loan. But I can pretty much guarantee that all of these loans that we're going over, these 1 to 4 unit DSCR loans, are going to be recourse loans that are personally guaranteed by the borrower, even if closing in an entity.
All right, perfect. All right, well, remember, again, 11 a.m. Eastern time, every weekday we do this show where we go through the live rates and then do a deep dive into a different topic. So we'll be back next week with some new topics. Happy Friday, everyone. Thank you for tuning in. Thank you, Jose. Everyone have a great weekend. We'll see you Monday, 11 a.m. Eastern for the next episode of Daily Rates Live with the Mortgage